بله سلام، اسمم تیمور کامرانی است از برنامه همبستگی افغانان. خوش آمدید به برنامه. امشب ما یک دوستا را آوردیم با ما صحبت میکنیم درباره مالیه. از یک نگاه مالیه خود در هر ملک که باشیم یک civic responsibility که میگن است، باید همگی ما مالیه را باید بتیم به حکومت که اونا امنیت ما رو بگیرن، برق آب کمک های ما رو کنن. پالیسی ما میخوایم ببینیم که اگر امکاناتش باشه کدام راه باشه که اگر چیزی که مالیه که مثلا صفایی باشه خب باید بتین. پالیسی یگان مالیه که خود حکومت میگیره از یگان راه است که مثلا امکاناتش باشه که ما میتونیم که یک ذره پول کمتر بتیم قانونی. دیگه درباره از صحبت میکنیم. دوست ما اسمش است رابرت کاردوزا، تقریبا 34 سال به امریکا کار میکنه به حیث CPA Certified Public Accountant. قبلا بزنس از خود داشت تقریبا 25 سال و یک چند وقت پیش تقاعدی خود گرفت. خب بر صورت درباره صحبت میکنیم. پیش از او میخواستم که یک دو سه موضوع همین دوستا است که با ما ایمیل کردن. تشکر از ایمیل هایتان، تشکر از تلفن هایتان و از فیسبوک و همچنان لینکدین اکانت که روان کردین. یک سه برنامه که من یکی است به نام Rebuild Afghanistan Summit که به تاریخ اول اپریل در لس آنجلس می باشه، در UCLA University of California لس آنجلس از 10 صبح تا 4 دیگر. اگر علاقه دارین و میخواین که به این پروگرام اشتراک کنین همگی میتونن برن. فی و چیزی ندارن. فعلا چیزی که میبینیم یک وبسایت دارن به نام afghansummit.org. باز داخل برنامه یک ذره باش صحبت میکنیم. چندین ورکشاپ دارن که شما اگر علاقه داشتین میخواستین به وطن کمک کنین یا میخواستین اگر برین دوستا رو ببینین یک نتورک کنین، به نظر من خوب پروگرام است. پالیسی یکی از این دوستان از لندن ایمیل روان کرد که میخواست که ما برای دوستا یک اعلانشان تیر کنیم که در تاریخ 8 اپریل اونا سالانه و تجلیل میکنه. سالانه خود نوروز هفته گذشته بود، مگر اینا میمانی خود در 8 اپریل میگیرن از 5 دیگر تا 12 صبح. اگر علاقه داشتین به دوست ما احمد ولی مجیدیار به تماس شوین. میتونید که معلومات بگیرین از طریق فیسبوک. و سومی اعلان ماست درباره یک پروگرام است به نام اسلامیک فایننس پیور پیسه که یعنی اگر علاقه داشتین که درباره اسلامیک فایننس یاد بگیرین، یک کورس دارن که 4 روز است از 6 اپریل الی 8 اپریل و همچنان از 14 الی 15 در خود فولرتن در کال استیت فولرتن است. و این معلومات باز بخیر به وبسایت میمانیم. شما باز اگر علاقه داشتین یا با ما تماس شوین یا میتونین از طریق وبسایت ما zarintv.net شما میتونین که این معلومات بگیرین. خب بسیار خوب، ما میشه که امی برنامه را درباره صحبت کنیم. دوست ما رو که آوردیم اینا درباره مالیه صحبت میکنن. خودش تقریبا 34 سال قبلا به می شخص کار میکرد و میخواستیم که به شما یک ذره معلومات بتیم. هم کسایی که دوستایی که در خود امریکا زندگی میکنن اینا میفهمن که امی تکس سیزن تقریبا یک 2-3 هفته دیگه مانده، مگر ما میخواستیم که یک ذره معلومات بتیم درباره پلانینگ به سال آینده شما چی کارا کنین، چی رکورد کیپینگ باشه، چی که اگر کدام استراتژی چیزی باشه که به شما کمک کنن. خب بر صورت دوست خودم معرفی میکنیم. متاسفانه دوست ما فارسی یاد نداره یا پشتو یاد نداره، از اون نگاه به انگلیسی صحبت میکنیم. اگر کدام سوال داشتین زنگ بزنین. اگر شما میخواستین که باز بعد از برنامه همراهشون به تماس شوین، باز ما همچنان شماره تلفنشون به شما میرسانیم. معلوماتشون به وبسایت خود میمانیم. خب بسیار خوب. Robert, thank you so much for joining us. Really appreciate your time. Like I introduced to the folks here that you've been in business for 34 years and you're a professional. You have a handful of degrees. If you can, yeah, I don't think you left any degrees on the table.
No, not many.
So if you wouldn't mind, I've known you since the late 90s, so almost about 15 years. But if you wouldn't mind introducing yourself to our viewers so that they have better idea as far as your background.
Certainly. as you've already been told, my name is Robert Cardoza. I've got my bachelor's degree in accounting. I've got my master's degree in business administration, and I've got a PhD in international finance. I have been in practice for 35 years, over 35 years. I've been saying 35 years for a long time. So I've just recently semi-retired. I'm still doing a lot of consulting and a lot of tax work for businesses and some individuals that have businesses. And that's just to keep my fingers in, because I do a radio show every day, Monday through Friday. It's called Robert Cardoza Live. It's on an NBC affiliate at KCAA Radio 1050 AM.
And that's here in Southern California, or is that nationwide?
No, it's actually broadcast live in Southern California from Palm Springs to Pomona, Victorville to Laguna Niguel.
Okay.
But we're also on internet radio, so it's at kcaaradio.com. You can go on the internet worldwide.
Okay.
And we're broadcasting in 95 countries on live internet TV.
Okay.
On HD.
Great.
So my show talks about politics, money, and you. We try to give people the same kind of tips that you're doing here today.
Right.
And I get a little, let's say, caustic sometimes with the government, with things that I see. I try to be as nonpartisan as possible, but I call it the way I see it.
Right.
Call it the way I see it. So that's where it's at. People wanted to see a little more about me, they can go to my website at robertcardozalive.com. Everything is there, and if they want any questions, they could feel free to email me at robertcardozalive@gmail.com, and I answer all those emails, whether I do it on the air or I'll do it individually. They'll get the answers.
Great. Well, they're certainly welcome to dial in today, too. As we go through the program, we're going to talk about a handful of topics. We'll start off with some topics that I think a lot of folks can resonate with, and part of that being foreclosures, part of it being, short sales in real estate, and debt cancellation. It's a relatively short topic. However, I think that some of the advice that you'll get here is quite valuable and timely. But before we go any further, I want to go ahead and play a short video for you, just to give you an idea as far as how taxes can impact you in the long run. In other words, like I said earlier, paying taxes is everyone's civic responsibility. It pays for a lot of things, including the security that we have, the lights, the streets, everything that you see around. So we always want to pay taxes, and regardless of where you are in the world. However, there are certain strategies that you can take. And now this short video will show you essentially if you were to, for example, take $1 and double it in a year, and you keep doing that over time, how long would it take for that dollar to become $1 million? Okay, and then the second part of it will show you essentially, what happens if you're taxed on that dollar every year? And you could see the difference between those 20-year periods. So let's go ahead and play that video, Fadi John, and we'll come right back after this, and we'll talk about our topics.
Usually is hold it up to the mirror. That'll work. First of all, let me give you an example that something really shocks people. I believe it was Donald Trump who said if he started off with $1 and your money doubles every year without paying taxes, so at the end of 1 year it's worth $2, and at the end of 2 years it's $4, how long would it take for you to be worth $1 million or more? And the answer is 20 years. You'd be worth actually about $1,048,000. Now, same dollar doubling, but let's assume we pay 35% in taxes. And when you consider federal tax, state tax or provincial up in Canada, sales tax, capital gains tax, excise taxes, 35% is not that high. So a dollar doubling is not $2 because you got to pay 35% of that increase in taxes, so it's only worth $1.65. Same 20 years, same dollar doubling, but now it's only worth $27,400. What's the difference? It's the interest. You're losing the interest on the money you paid the government. Albert Einstein once said that the eighth wonder of the world is compound interest. It can work for you by reducing your taxes to the legal minimum, or it can work against you by overpaying your taxes. We all have that wheel of life, folks. We all have the expenses of mortgages and expenses of education for our kids and retirement for ourselves and medical and dental and so on. How do we get the money to pay these things? Well, we can go on a financial diet, but diets don't generally work. The other way is to reduce your taxes legally, morally, and ethically and learn how to do it. And by doing that, you can save the money, use that to pay off your debt, and get out of every debt within 15 years. How does that sound? It should sound pretty great because it happened to me, so I know it works. If you haven't caught on to the fact that TaxBot can save you literally thousands of dollars every year, then you're just insane. If it takes you 20 seconds to record a deduction, this translates into the most profitable minutes of your day. I mean, we're talking over $1,200 an hour, tax-free. Sounds pretty good to me.
So there you have it. As you noticed, if the power of compounding and also the effect of taxes that will have on your savings over the long run. And if you noticed in the video, they showed $1 doubling every year, not being taxed. It would take 20 years, only 20 years for $1 to turn into $1 million. However, if you're taxed every year on your earnings, and that's just a normal tax rate here in the U.S., that $1 would only turn to $27,000 in 20 years. Huge difference. Which brings us to the topic here, and we have a professional who can actually give us some ideas on what are some of the steps that we can take for starters to prepare for taxes, both on an individual basis and also on the corporate basis.
First of all, let me just make this comment because I said it to you earlier, and I think we ought to say it live.
Yeah.
And that is that you need to do everything you can in order to preserve discretionary income for yourself.
Right.
We've already had proven to us by Congress how prudently they can use our money.
Right.
You need to be doing some things for yourself, and planning is certainly part of that. Right?
Absolutely.
So when we start talking about planning, it really is too late to be planning for 2011. You need to be planning for 2012.
Correct.
And beyond, and certainly far beyond.
Right.
And I believe that's what your video is trying to drive home.
Absolutely.
When you start planning, you've got to try and figure out a way that you can get the government to contribute to your plan, and you do that through tax planning.
Right.
To reduce your tax liabilities and bring down your tax brackets as much as you can. There are many vehicles you can do that with, depending on whether you're an individual working for wages or if you're an employer that is self-employed, well, depending on the kind of employment that you're in,
Right.
through qualified plans so that you can put money in there that are tax deductible to you now,
Right.
that grow tax deferred, so hopefully we can get you into a lower tax bracket
In the long run.
in the long run,
Right.
and have you preserve that money. But because of the compounding,
Right.
you now can amass much greater funds in the long run for your retirement.
Right.
We already know that Social Security or the basic retirement funds are just not going to do it for you when you retire. You have to do something yourself. Social Security and your other retirement programs probably are going to produce somewhere around 25% of what your real needs are going to be at retirement. So you've got to be thinking in a panic mode and say, wow, I've got to do something because the government's not going to do it for me. Right? So you need to be making some investments, and to do that you need some proper planning. So let's talk about planning if you're a business first, and then we'll go into individuals, because one kind of goes to the other.
Absolutely.
Now, when you are in business, you've got to be thinking very, very seriously about an entity choice that you're going to be in business, because that's what's going to have a big impact on how you're going to be taxed.
So when you talk about entity, you're talking about whether it's a corporation, LLC, partnership, which
sole
one's
proprietorship.
which, what do these things mean?
What are
really?
the benefits?
Right.
What are the deficits
Right.
of each one of those? Most businesses start out as a sole proprietorship, and that's just a regular business that's recognized on your 1040, your regular tax return.
So there's just
on
one
Schedule
return.
C.
Right.
It's just one return. It's sitting there, Schedule C.
Okay.
And there are some benefits and there are some deficits to that. The benefits is that so many people go into business and they really don't know if they're going to make it. They don't know what's going to happen. And so starting off as a sole proprietorship, probably not a bad idea if you're not getting involved in a business that has a lot of liability, to see if you're going to make it, to see if the business is going to
Why
grow.
set up the entity if you're not going to follow through in the long run?
Absolutely. And, we've all heard on the radio and on television, set up a Nevada corporation, set up the Delaware corporation.
Right. So what is the difference, really, before we go to... I hear Delaware, apparently a lot of large companies are Delaware, and then there's Nevada, which supposedly there's a lot of tax savings, but is there really?
Well, there is. What they're not telling you, these companies that are doing this are really doing it to make fees.
Naturally.
And that's the thing. Because let's just use you as an example.
Okay.
And you're in business here in California, and somebody talks you into setting up a Nevada corporation, because Nevada's a no-tax state. So
on
that
the
sounds really
state
good.
tax, not federal.
Yeah, on the
tax.
state tax, not the
Right,
federal.
right.
So that sounds really enticing, doesn't
Sure.
it? Except that,
100%.
one, to be a Nevada corporation or Delaware or Washington or Texas or Tennessee or Florida, any of those no tax states,
Right.
you must have a residency requirement. Your business
naturally.
must be in that state.
Right.
You need to have a business license in that state.
Right.
You need a phone number and a bank account in that state. And then, because you're actually doing business in California
Right.
or any of the other states, you need to register in those states as a foreign corporation doing business in those states, which generally costs you more money than if you had incorporated in those states to begin with.
Okay, so that whole tax incentive really isn't there.
It's not
There's
there.
a lot more fees, a lot more complication, quite frankly.
A lot of
Especially
complication.
on the small business.
Now, I can tell you that there are times when I have actually suggested that to a client, but they've been a manufacturer. Maybe maybe they build homes or they build roofs or they do some kind of manufacturing.
Right.
And what we can do is we can then actually legitimately set up a corporation, a C corporation, in another state.
Right.
We create the residency there, whether depending on how big the company is,
Right.
whether you're either buying an apartment or an office, or you're renting one from a mailboxes, etc., one of those kind of places. But you
Right.
get the license, you get the phone number, get
As
mail
simple as
forwarding,
that.
you do all
Right.
those things. But what we wind up doing is that entity is there. Let's just
Right.
use Nevada as an example.
Okay.
So that what we wind up doing is, and I'm the builder, instead of buying all my lumber and my nails and all my things from my business here in California through it
Right.
to do my construction, what I've done is I've set up a wholesale business in Nevada.
For yourself?
Separate from that.
Okay.
And I'll service any other company
Okay.
as well, but
Right.
separate from that.
Okay.
And so what I wind up doing is I contact all my vendors I've been doing business with, and I say, hey, I'm no longer buying from you.
Okay.
I set up a new entity, and I want you to set up the accounts through that entity.
Okay.
Now what the entity does is it calls them and say, okay, I want 10 loads of lumber,
Right.
but I want it drop shipped to this address in California.
Okay.
But you bill me in Nevada.
And Nevada.
And I'm going to
got it.
pay you out of my Nevada accounts,
Okay.
right? So now what happens is, are you familiar with keystoning, Taymor?
No. If you could explain
Keystoning,
that.
yeah, keystoning, if I keystone something, I've doubled my cost. So if
And
if
why
if
would you do that?
it's going to make sense in a minute. So let's say that all this lumber cost me $10,000.
Right.
Okay, but I bought it from this Nevada company, who gets billed the $10,000.
Right.
They resell it to me in California for $20,000. That's a keystone.
Okay.
My cost of goods just now doubled. What happens to your profit if your cost of goods doubles?
It goes down.
Goes down. Because I'm paying taxes in California.
Right.
I'm paying less California tax
Okay.
and less federal tax in California, right?
Right.
I'm still paying the federal tax out of Nevada,
Right.
but I've saved this 9% California state tax
Right. 10%.
on that amount of money,
Right.
right? The federal government doesn't care because they're getting all their money anyway. They don't care, right?
Now, it's really up to the state. Do they really care?
Nothing they can do.
Oh, okay.
Yeah, it's a totally legal maneuver.
So
It's-
there's two things that I learned here. Number one is that you have to hire a professional to do this for you.
Oh,
This
yeah.
is something you cannot do yourself. And then secondly, there are benefits in actually looking at different strategies. In other words, you don't necessarily have to do your strategies as you have been.
No.
Now, these things change over time. How often and how quickly do these tax policies change?
Well, there are about 2,500 to 3,000 tax law changes every day.
Every day?
I'm
Or
sorry, every year.
Every
Every
year,
year.
okay.
I'm sorry.
Okay.
But the issue is that all of those tax law changes don't directly impact everybody. And they don't always, and very few of them directly involve the taxability of taxable income
Right.
for businesses. It involves credits and those kinds of things.
Okay.
And employees and withholding and payroll and all those kinds of things.
Right.
So you have to keep track of those things, and you want to keep track of the credits that are available. A good example is I'm working with a company now that is going to be building certified LEED green entertainment centers.
Right.
In my research, what I found was the federal government is going to allow them a $1.80 per square foot tax credit for everything they build, the pools, the slides, the offices,
Because
everything.
it's considered green.
Because it's considered
So green
being
is,
certified.
is really the that you have to be certified.
It has to be certified.
What is it?
Yeah.
I mean, what does it take to be certified green?
Well, actually, there is an organization that actually certifies that for you.
Okay.
And it's based on the
Amount of, I guess, recycled
recycling.
use?
Yes,
Okay.
and it's 100%. You want to get it to be as
Close
close
to
to 100% as you can
Okay.
get. So that's just one example of
Right,
what you would
okay.
wind up doing.
Right.
So let's talk about the business entities. We talked about the corporations
Right,
a little bit. We
right,
talked about if you're a sole proprietorship, whatever your net profit is, you've got your sales, all your revenue, you've got the cost of getting that revenue, you've got your administrative costs there, you get down to a bottom line,
Right.
and that's your net profit.
Right.
That number is going to be subject to what they refer to as self-employment tax.
And that's on a sole proprietor.
That's on a sole proprietor.
Right, okay.
Now, self-employment tax is nothing more than Social Security and Medicare. But if you were working for a company, they would take out Social Security and Medicare from your check.
Anyways,
They're
right.
taking half of it. The employer has to pay the other half. If you're self-employed, you pay both halves.
Right, so it's 6%.
It's going to be closer. It's not 6%. It's going to be closer to 15%. When you're
Between
paying
the two.
both sides. Yeah.
Between the two, right. Okay.
And so basically what winds up happening is that you're paying both sides of that.
Right.
You're not getting away with it.
And that's from the profit.
And that's from the profit.
Okay.
Now, let's assume that somebody's talked you into becoming an LLC, and there's some places where that does make a lot of sense.
Okay.
Now, the great part about an LLC is you have some limited liability, depending on the kind of business that you're in.
Okay.
The downside to that, with almost every state, is that you have to pay for the privilege of being an LLC, number one.
Okay.
And here in California, you pay $800 a year,
Right.
or 1.5% of your gross revenue before any deductions.
Whichever is more or less, or is it just your choice?
No, it's whatever's more. It's never going to be your
not less?
choice.
Okay.
No. This is not a country of choices.
Okay. So what's the primary benefit of having an LLC?
An LLC is mostly for medical practices, where what you want to do is you have a lot of physicians involved in the practice. They put enough funds in there to run the practice, but one doctor's not liable for the actions of another.
Of the other. So it's primarily for liability.
Right. That's exactly what it's for. And the problem with it, though, is that the federal government doesn't recognize LLCs. The federal government, and the reason for that is that every state has its own, and every one has different rules. So the federal government just doesn't recognize it. So if you're a single member LLC, they treat you as though you were a sole proprietorship.
Of the entire, or just the portion that you're responsible for?
The entire.
Okay.
And so they treat it as a sole proprietorship. You've got to put it on a Schedule C.
Okay.
If you're a multi-member LLC, then the government says, okay, you're a partnership.
Okay.
You're still not
Right.
And so those things haven't been tested in the courts, and you're still paying self-employment tax on that net.
Okay. Now, are you taxed twice? In
No,
general?
no,
Okay.
no,
Okay.
no.
It's just that same.
But you're paying
personal
self-employment tax.
Right. Okay.
Now we get into the other entity, which would be a corporate or a partnership, I guess you'd say.
Right.
We've already kind of talked about it. It works the same way as an LLC, and you're paying the self-employment tax, no liability protection. Every partner is 100% liable for the actions of everybody else in the company.
Right.
So that's really not your favorite way to go.
Okay.
Okay? Now, if you became a C corporation, which is the one that everybody really hears about all the time, it's a standalone corporation. It was as though you had a child. The government recognizes it as a separate entity in the eyes of the law.
Its own.
On its own. And so it pays its own taxes. And this is what you're hearing in the news today about let's get this 35% corporate tax down to 25% or where we can get it
And
down.
that's the standard, 35%.
That's on the corporation.
Okay. Regardless of what amount of deductions, whatnot you have.
Well, it depends. That's really not true. For the first $75,000 worth of retained earnings on a corporation, there's only a 15% tax rate. Then it moves right into the 35.
On the total amount, or the amount that's beyond
the
75?
amount that's beyond.
Okay, well
The amount
that's
that's
a
beyond.
fair amount.
Yeah.
That's not bad.
But if you're talking about multi-billion-dollar companies or multi-million-dollar
Oh,
companies,
it wouldn't matter. We're talking about self-proprietors.
big
and-
bucks.
yeah.
Yeah, big bucks.
Okay.
So what winds up happening, this is where the comment you made about double taxation comes
Right.
in. Because when you are required to pay the officers of the company a reasonable salary for what they're doing, that and collectively cannot be less than 1/3 of the net profit of the company for all the officers collectively. The balance of the money, and usually it's the officers in the small corporation, that's all there is officers, right? So the balance of that then in the corporation becomes what goes out in dividends.
Okay.
But you pay the corporate tax before the dividends.
So you're taxed twice.
And dividends are not a tax deduction. Then you distribute the dividends to the shareholders,
who then they get taxed again.
Get taxed again.
Wow. Okay.
So now it becomes really bigger. If you had 15% of that 35, you got 50% tax, right?
50% tax.
That's a big deal.
Right. It is. Yeah.
So then the best of all worlds, my favorite of them all, is the Subchapter S Corporation.
Okay.
Now the Subchapter S Corporation works a little bit like an LLC, but you get the total protection of a corporation,
okay,
and you still pay that $800 minimum fee or 1.5%, but it's on your net profit, not on your gross revenue.
Big difference.
Big difference. Yeah. You still have to pay that minimum salary to the officers we're talking about, right, up to a third. However, the balance doesn't go out in a dividend. It's what they call a pass-through, and it goes on a Form K-1, just like a partnership does, that attaches to your personal 1040.
Okay.
Except that it goes on Schedule E.
On the personal.
Okay. And it is not subject to self-employment tax, which means that 2/3 of your income, you're not paying that 15% on.
Right.
That's a tremendous savings. It doesn't take much. If you're netting $100,000, it just saves you $15,000 in taxes,
which is a substantial amount of money.
Right. Yeah. It's a big thing.
Right.
And that's just one. That's how the entities go. We could talk about entities for a long time.
Right.
Tremendous benefits to using either a C corporation or a Subchapter S corporation that you can't get in an LLC, you can't get in a sole proprietorship. One of the things that you can do is what they refer to as self-leasing.
Okay.
So what I tell clients all the time is do not buy assets in your corporate entity, regardless of which corporate entity it is.
Because you want to pull it out, you have to pay tax on
it.
Well,
if you buy the assets yourself,
right, and you lease
and you now have a Schedule C that's a leasing company,
okay,
and that's totally legal.
Right.
You now can lease all of your computers, your cars, your phones, your everything
to the business.
Okay. But there must be a profit motive.
Okay.
So we figure out what your actual costs are, and we multiply that by 5%, or 1.05, right?
Okay.
So that we're guaranteed you're going to make 5% on it because
as you lease it,
95% of it's going to be offset by depreciation. It's income property.
Right. That's right.
So the money the corporation pays in is 100% tax deductible.
Right.
The money you got, 95% is offset by depreciation.
Right.
So you pay no tax at all on that money,
right,
and you're paying tax on the 5%. That's it.
That's all you.
That's a much better deal.
That is
right,
much better.
And you got two tax deductions for the price of one.
But then you have all these assets on your own. Are there any kind of liabilities that might actually arise from that by you leasing something to the business? And
what we generally do is we lease it to the business, requiring the business to pay for the insurance, the maintenance,
so it's
all the liabilities,
all hands off, right?
All that's hands off.
Okay.
For those people that are tremendously worried about it, then it's a pretty simple setup to just set up another separate Subchapter S corporation
that would lease,
that would hold the lease stuff.
Like, for example, if you have a business where you're delivering, let's say, if you're a catering company, or if you have some kind of a delivery service, where you take a vehicle from one place to another place, and unfortunately, you get into an accident, something happens. Now the question is, who's responsible here, right? Who did they come after?
What a beautiful thing. What a great comment. And I would have probably not mentioned this, but it's a great opportunity for people. Think about this. All of the liability for your business is in the operating business, right? The operating company. The operating company doesn't own any assets. The only thing it owns is accounts receivable.
Right.
Right? So if something did happen, some accident, and they sued the company, it doesn't own anything. So what are they going to get?
Nothing.
Now, they could go after the accounts receivable, but the accounts receivable are pledged as collateral for the long-term leases.
Right.
So anybody that was going to get that would have to pay you those long-term leases.
Which you can cancel anyways.
Yeah. So who cares?
Okay, so this is really important because there are a handful of folks that I personally know that live in this Southern California region who, in fact, are in a business of, for example, catering food to various events. Now, we have very delicious food that we like to have at our weddings and events.
Well, I notice you don't have it here at the studio.
No, we don't. But we will actually. We will have it. And so the point is that if, for example, you have a sole proprietorship and the car is your car and you're delivering the food, you can really get into some, a predicament if you don't have all these different entities. And again, it comes back to the earlier comment that I made, which is you need to be able to actually reach out to a professional like Robert, who can actually help you and make sure that not only are you not liable for, let's say, for example, an unfortunate accident, But you can also save money, and in the long run, you end up in a much better financial position.
You know, I believe, I think that you are right on the money when you said it's everyone's civic responsibility to pay their fair share of taxes. I go a step farther, and not one single penny more
than what you
really are required to pay.
Absolutely.
You know, and so you've got to be smart.
You don't get a certificate of achievement from the IRS for paying more, right?
No. They don't even say thank you.
Okay.
You know, here's the issue with the IRS.
Okay.
You know, or not the IRS so much, but the thing is that when you go to a professional,
right,
if they're not going to save you demonstrably more money than they cost you, then it's not worth going there.
It's not worth going, right?
They should, just you sitting down there, they should be, just what we've said right here, could save people thousands of dollars, and that's just a normal day in the eyes of a professional.
Just knowing that there should be separate entities set up for these things. Okay.
And it's just analyzing
advice,
the business.
But it's complex in executing this. Let's talk a little bit more about these various entities. What are some of the other benefits of, for example?
Oh, good. Let's assume you've got young children.
Right.
And you can actually put your young children to work in your business. You give them a paycheck. It's not subject to Social Security or Medicare or workers' comp.
So are you saying that would they be considered employees, or are
they would be
1099?
No, they would be employees on a W-2.
Okay.
But the nice part about it is if you pay them $3,000 a year, there's no tax return requirement
on each one of those folks.
On each one of those kids, on the kids, right? Okay. Now, if you don't care about the tax return, then pay them $5,000 a year. Let them put $2,000 of it into a standard IRA. Right. Let them put the other $3,000 into a Roth IRA.
So basically, start early, start off that.
Right. So if a kid is 9, 10, 11. They can be, putting out the trash, dusting the office, doing all kinds of things for you, justifies the salary. Right. And you can be setting this money aside in a tremendous way. And if we're talking about standard IRAs or Roth IRAs, or just the $3,000 and they put it into an investment account, they can do that too. Okay. But if we're talking about tax deferred issues, the nice beauty about that, and I like them better than the educational 529 plans and those kinds of things, because they're so flexible.
They're flexible, right?
The young kid can use it for education with no penalty for early withdrawal. Right. They can use it for a first-time home purchase with no penalty for early withdrawal. Right. They can use it for medical needs with no penalty for early withdrawal. Right. And they can use it if they have financial problems with no penalty for early withdrawal.
Okay, so that's interesting. So we're talking about Roth IRAs and IRAs.
Yeah.
Right. The last item there, as far as financial problems, can you? How is that classified? In other words, I could have financial problems every day. I want to go to the store and I don't have change in my pocket. Well, that's considered financial hardship on my part.
Well, it's got. Maybe you've lost your job, or maybe you've had to take a job making half the money you're making. You're having a difficult time putting food on the table and paying for your insurance and maybe the school
making
the house payment.
Right.
You're having a financial hardship. Okay. You now can take money out. Now, here's the issue: if you take it out of a standard IRA, you're going to have to pay the tax, but you'll be absolved of the 10% penalty. Okay. If you take it out of a Roth, there is no tax.
Because you've already paid for the tax.
Right. There is no tax and there is no penalty.
Okay.
And so that's a great way of planning for the kid's future.
Absolutely.
And if they don't use it and it goes into retirement, we've already shown what can happen if you're over time, if that money is in there compounding, right?
That's right.
So we're not talking about $1 a year anymore. We're talking about $3,000 a year.
That's right.
So what is that? That turns out to be millions.
Correct.
So
absolutely.
Huge things.
And so this is basically another benefit of having one of these entities that you could set up where you have your kids work in there. And in fact, if you notice, there's a little child here in the studio, and I'm sure that his mom is back there thinking already, how can I put this kid to work? Yeah. So what are some other benefits?
What a great thing. Let's stay with kids for a minute.
Okay.
Let's assume that you put into the bylaws of your corporation that your corporation will pay for the education for any employee that it deems that education would be a benefit to the company.
To the company, right.
Okay? Right. Now
Which is common.
Yeah.
A lot of companies do this.
You need to be a little careful, and we'll talk about that. But now the company can actually pay for that college education.
From the company's
From the
assets.
company.
Right.
It's a tax deduction. It's not taxable to the recipient.
Right.
Good thing. Now, the part you have to be careful about is there are discrimination rules with not only retirement plans, but with these educational issues, where if you do hire someone that's not a family member, you have to offer them the exact same program.
Absolutely.
So it depends on how benevolent you want to be, but there are opportunities there for that, right?
Okay.
Then you have, key man insurance. When I first started my business, or even now, even your business,
Right.
You build that business around you and around your reputation and your name. And people don't do business with companies. People do business with people. Right?
Absolutely.
And so what happens if something happens to you? What happens to your wife and your children if you drop dead tomorrow?
Right.
So in comes this concept of key man insurance. It's just life insurance.
Okay.
But because you title it key man insurance, the company can now pay for it.
Right.
Tax deductible to the company.
Right.
And the purpose of that is so that the company can now pay your wife the proceeds, and the insurance proceeds are non-taxable.
To the recipient.
To the recipient. Right.
So now you said key man, and obviously key man, key woman, it's the same.
Yeah.
But the point is that key man, now is that pretty much for one or two people, or can you set up a group of folks that you...
Could, you might have a president.
Right. That's key.
And you might have a
chief
financial officer, chief operating officer, the chairman of the board, people that are critical to your business.
To make the continuity of the business.
And you can isolate them, and you can provide them all with insurance.
Right. And so the IRS essentially would look at that as a way of preserving the income for those individuals.
That's
because
right.
Should that one person die, somehow you need to offset that for
the real logic behind it is that if you had a business like that, and it doesn't always work this way, but this is the logic, then if you and I were in business together, you would insure, or the company would insure my life, it would insure your life.
Right.
Because if something happened to one of us, you wouldn't necessarily want to do business with the other person's wife. Right? So the purpose of that money is to pay her for her share of the business.
To buy you out, basically.
To buy you out. When they buy you out, if you've set your structure up correctly, then what they're doing is they're buying your stock, right? So the worst then you have basis, and basis is nothing more than cost. Okay, so what winds up happening is regardless of what the basis is, you right now never pay more than 15% tax. No matter how many millions that turns out to be. Okay. That's how Mitt Romney and Bill Gates and Warren Buffett stay in this lower tax bracket, because all of their money is a derivative of investment.
That's right. Well, these are really good things to think about. I mean, I'm speechless because now I'm thinking, okay, what are some of the ways that I can go home tonight and actually write this down and come up with some strategies? Well, the first thing I would do is obviously contact the professional, work with the folks that you're working with. You can certainly tune into Robert's radio station and fine-tune your strategies. Some of the things that we really covered are essentially advanced planning, which is very important. We talked about retirement planning, which again is very important. In other words, Social Security, like Robert said, the Social Security benefits only cover 25% of what you would need in the future. In other words, how do you make up for the difference? Well, you got to plan ahead. And some of the strategies that we talked about, whether it be Roth IRA, whether it be IRA, KEO, whatever the plans are, they are both a tax benefit to yourself today and also a benefit to you in the future. For example, life insurance with the corporation, where the corporation pays for it, it's a tax benefit to the corporation, and it's a benefit to you should something happen. Are all great.
Let's talk about a couple of strategies. One with life insurance. If the company actually pays for the life insurance, and it's a universal policy, let's just say your whole life policy.
Okay.
What winds up happening is it's going to gain cash value, right? And what the executive can do is they can borrow against that policy.
Against the cash value?
Against the cash value. Against the cash value.
So whatever. It's
because the total value is only if you die, right?
That's right.
So, against the cash value. But they can never borrow more than if they die, the policy can pay off the loan on.
Naturally. Right.
But because it's borrowed money, it's not taxable income to you.
It's just a loan.
And because insurance proceeds paid it off, it never is taxable income to you.
Right.
That's a real great way to use these.
So what happens if you have that loan and the person passes on?
Then the insurance pays the loan amount
first, and then the difference to you.
Then the beneficiary.
Okay.
And then the other thing is, if you're talking, let's just say a solo 401k, which is just another qualified plan, right? But you can put up to $45,000 into a solo 401k, depending on what the nets are, and it's totally deductible, whether it's totally contributed to by the company or maybe it's a mixed bag between the individual and the company. It depends on how you want to set it up.
Right.
But $45,000 is a pretty nice chunk to put away.
And tax-free, too.
And tax-free.
That's right.
Yeah.
Absolutely. Well, these are some good strategies. What I want to do is actually take a short break so that we can run some more commercials and pay our bills. We also have a video that we wanted to play for you. And then when we come back, I wanted to talk a little bit about the individual.
Absolutely.
Right? What happens on an individual basis, for example. You have certain strategies that work on the corporate side, but what about on the if you're just an employee, for example, if you just finished school, let's say a few years back, and you're working 5-10 years or whatnot, what are some of the basic steps that you can take? Some deductions, some things that can help you save or essentially not pay taxes. So. Why don't we go ahead and get into that topic? It looks like in the control room they're not ready for a break yet. So if we can talk about on an individual basis, and then we'll come back afterwards and talk about a big topic that really is affecting a tremendous amount of Americans today, which is foreclosures and short sales, and what exactly happens, if you have a home that you really need to get rid of. What are the tax implications? We'll come back into that. But let's talk about on an individual basis.
Many individuals have unique circumstances and expenses. And let me give you a couple of examples. Police officers. Let's just use the Los Angeles Police Department for an example. Okay. The Los Angeles Police Department gives a $1,000 uniform allowance to the police officer. It's taxed to them on their W-2. They're paying the tax on it.
Right, and the uniform really is not some tax code, it's their clothes.
Yeah.
Right.
Yes, yeah. Okay. And so what happens is because they are taxed on it, when they spend money on uniforms, whether that be for backup weapons or uniforms or leather goods or handcuffs or mace, ammunition at the range, driving to and from court in their own vehicles, those things all become what they refer to as non-reimbursed employee expenses. Oh, okay. They're totally tax deductible to the extent that they exceed 2% of your adjusted gross income.
Okay. So that's something that, for example, the employer doesn't pay for.
Right.
Beyond what they're now going back the $4,000. Now, would they be taxed on that, or does the corporation?
No, it's not. It's $1,000.
The city pays for.
No. The city gives each officer $1,000 a year.
That's all.
It's a uniform allowance.
Wow.
But they're taxed on it, not the city, the employee, the officer. When they use that money, and they have to use it, they're ripping up their uniforms and they're doing, wearing things out.
Yeah, you're wrestling with people.
When they buy it, that becomes a total 100% tax deduction for the officer.
Okay.
If you're a pilot, the uniforms are deductible. Your maps, are all deductible
Navigation
to you.
And all that,
Your flight
maps and
stuff is all deductible to you. If you're in construction, all your tools are deductible to you. If you have to use your own vehicle, that's going to be deductible to you. So you have to be thinking about those things. And what happens is that a lot of people that want to go to, and I'm not going to mention any names, but some of these go online, do your own tax things. They're going to let you put anything in there that you want.
Right.
It's just that simple.
Right.
And if you put it in, it must be okay. The thing is that it's not going to know about a lot of things, and when you're using these non-reimbursed employee expenses, when you get above a certain level or you're doing a lot of extra things, you need to use a different form for that to be recognized by the IRS, and it's called a Form 2106. That's non-reimbursed employee expenses. And that's where you would itemize all these things, and it would isolate you. And there could be one for you and one for your wife. Depends on what's going on.
Right.
But they have that for every industry. Okay. And you can imagine if you're in the construction industry, these guys are buying tools all the time.
Sure.
and they're having to go through these things.
Absolutely. Yeah. You lose your tools, they break. Yeah. What about uniform? They also have that. Right?
Absolutely. Matter of fact, if you're, let's say you're a mechanic, you're dealing with toxic stuff.
Right.
even though it's not you usually have a uniform shirt, but the rest of your clothes that you're using for that, you can't use them for anything else. And the government criteria is, if you can use this on the street in everyday life, then it's not a uniform and you can't deduct it.
It's just clothes. Right.
But when it comes to some industries, it's a little different because you're dealing with toxic materials that you're not going to wear that on the street, right?
You can't.
It's not going to happen.
Right.
If you're a physician, I mean, you might be a physician that works out of a hospital. The hospital doesn't provide you with any office or anything like that, so you might be seeing patients in the hospital.
Right.
But you're keeping your records and doing your billing at home.
Right.
Then your home is essentially a home office, and there's a way of allocating
There's
that.
a certain amount.
Yeah.
Okay.
And so it's an allocation according to percentage of use.
So if you're, for example, you're a doctor, a nurse, whatnot, you also have uniform.
Absolutely.
Right? They give you an allowance, and sometimes they don't.
Yeah, recurring
All
education.
of that can actually fall into this. Okay.
I know you have it. I have recurring education. We all have recurring education that becomes tax deductible to you.
Okay. Well, it looks like we have a caller. Let's go ahead and take this
Sure.
call and see who we have on the line here. Dari TV بفرمایید.
Assalamu alaikum.
وعلیکم السلام. صحت شما خوب است؟
Tashakkur, let me. Can I have a question from Robert? You just mentioned a 401k. If you have like, 45, 50,000, over 100,000 like that, if you borrow 50,000 or 40,000, that's good for you or no?
Well,
And borrow, then you have to pay like, bi-weekly or monthly.
Well, I think you're asking a couple different questions. First of all, we're talking about your net income, what's left over after all of your expenses for your business. And if you have $100,000, then you can put into a solo 401k up to $45,000 so that you're only paying taxes on that difference, because the $45,000 goes into a qualified retirement program.
Yeah, but if you put like 100,000, then you borrow like 20 or 30 or 50,000, then monthly you're paying, bi-weekly you're paying,
Borrowing against your 401k.
500, 600. That's good for you or no?
Well, here's...
like in 3 years you'll pay, in 5 years you'll pay off that 50,000 or 30,000 you're borrowing. That's good for you. That's good things or no? We're supposed to not do these things.
Well, keep in mind that when we're talking about $100,000 or $45,000, you're not going to be able to do that if you're working for another company and you're actually participating in their 401k program. You're going to be limited, and it won't be anywhere near that. On the other hand, if you're if you're self-employed, the amount that you can borrow, and usually the limitation is 50% of what is in your retirement program, is limited. And you can borrow against it. When you borrow against it, it's not going to be taxable to you. But if you do not put it back in, then it will be taxable to you in the year that you're no longer involved in that program. And if you're under 59 and a half, you're not only going to pay the tax, but you're going to pay a 10% penalty. So you want to be very careful about how you actually do that.
Okay, let me tell you, I work for this place, like right now I have 100,000. I want to borrow 30,000, from 401k. And, bi-weekly I have to pay back. It's for 5 years. Within 5 years I have to pay this 30,000.
Mm-hmm.
It's good I get to borrow it or no, it's not good that I get to borrow this money.
Well, it is. It's good for you because when you pay it back, depending on the terms of the 401k setup that the employer has, you're going to be paying it back to yourself, and generally with some interest. And you're going to be increasing your own retirement program. So it's still a good thing. And when you borrow it, there will be no tax on. There's never, ever any tax on borrowed funds, regardless of where you get the money from. But remember, if during this 5-year period, if you should leave that employment, you're going to be taxed on the amount of money that you have left on the balance of the loan.
But can you continue to pay that every 2 weeks?
Not if you leave. Not if you leave the employment.
Okay.
If you leave leave the employment, it's deemed to have been a loan not paid back and an early distribution.
Oh, I see. Okay. Okay. Now, could you pay the full amount? I mean, before you leave?
Yes.
Yeah.
Yes.
Okay. So that there's a couple options there. So the benefit, I guess, is that there's a certain amount of money that goes back into your 401k in terms of interest, and so. And not only that, but you're borrowing money that you wouldn't have to pay interest on from, let's say, a bank, for example. The pitfall, like you said, is that if you don't pay it back, you get hit with a 10% penalty if you're under 59 and a half. And it's also considered ordinary income, which it could be, up to maybe 50% of your income. So, so I guess it's a good thing, but just like chocolate, too much of it is not good.
Because in that 50,000 or 40,000, when we borrow money, your 401k, you just pay, interest rate, like just
very low.
4.75 or 4.75%.
Not bad.
Interest. Yeah. And that's why I was confused, but I just saw, Rob is talking about things and you're helping. I said, oh my God, this is good time. I'm glad I got you online, you can help me, that was
thank
my
you for
question.
dialing in.
Well, the thing is that if
you really appreciate it,
if you're borrowing this because you're having financial difficulties, then I think it's a good thing. You're borrowing money from yourself, and and as things get better in your personal situation, you'll pay that money back, and you won't have lost anything.
Thank you so much. God bless you for all your information. Really appreciate it helping us.
From your lips to God's ears.
Thank you for dialing in. Okay, good question.
Yeah.
Now, I think we're going to go ahead and take a couple commercials, and after the commercials, we'll come back and we'll talk a little bit more about the foreclosures, debt cancellation, that type of stuff, and what does it really mean? I mean, if you have a home you just want to get rid of, you can't pay the high mortgage payments, how would that benefit you or maybe hurt you? We'll talk a little bit more about that. So we'll go ahead, play this one video, and then we'll go into the commercial, and we'll come right back. Stay with us. Well, welcome back. I hope you enjoyed the first portion of the show where we talked about various entities, how you set up a business, whether you're a sole proprietor, whether you LLC, two different types of corporations, and what are some of the benefits. Bottom line really is about planning, making sure that you plan ahead, and also making sure that you put some money away in retirement so that you can live a comfortable retirement. Now, we did talk a little bit about on an individual basis, and the caller called in and asked a good question about borrowing against your 401k, where Robert actually answered the question as a sort of a double-edged sword. Now, it looks like we have another caller, so let's go ahead and take this call, and then we'll go into some other ways that individuals can actually benefit from some tax
Sounds
policies. Good. Okay. Zarin TV, bale befرمایید.
السلام علیکم برادران محترم، چطور هستین؟ خوب هستین؟ تشکر شما محبت شما یک جان تشکر. I have question. Thank you so much, Robert, for your helping us. I have a question. Like if you borrow money from 401k, around 50,000, and then you use it like you just mentioned, foreclosure, some good house or good land, that's worth it or not?
Absolutely, that's worth it.
Leads right into the topic.
Yes, absolutely, that's worth it. Matter of fact, what I was going to talk about before I knew that you were on the air was exactly that. If ever there was a good time to buy real property or a single-family home, this is it, because the adjustment in values in homes have made it a tremendous bargain, especially here in California where you've lost 40 or 50% of the value of your home. You're buying it at an adjusted rate now. And remember that for a recovery of our recession, you cannot have a recovery without inflation. And what inflation does is it increases the value of the home you're going to buy now. No, I would suspect that as we go through this recovery, we're going to be hitting somewhere around 2.5% or 3% inflation, which means the value of any home you bought today will be worth 3% more a year from today. And when you're borrowing money from your 401k to buy that home, you're actually leveraging what's there, because a portion of it is going to be with the down payment. The biggest part is going to be with borrowed money. The borrowed money doesn't even count into this. So let's just say, just for the sake of conversation, that you bought a place for $100,000, which would be a little more than a closet here in Southern California. But you wound up putting $20,000 down on that $100,000. Now, if you got 3% inflation, that means that the value of your home went up $3,000. but the return on your investment is greater. You made $3,000 on the $20,000.
Which
Of what you actually put in.
It's a lot more.
Right.
Actually, yeah.
So you wound up making a great deal more money. And the other thing is that when you're buying a home today, let's just make another assumption and say that you're in a 25% tax bracket. That means that because that mortgage interest and property taxes are tax deductible for you on a Schedule A, the itemized portion of your return, that the federal government's going to be paying 25% of that interest for you because it becomes a deduction at 25%.
Okay.
So you even make more return on your investment that way. And what most people don't realize is that unless you're buying a home, only about 12 to 13% of our entire nation qualifies to itemize their deductions, because if you're not buying a home, you don't have enough expenses to justify itemizing. And it's the interest and the property taxes that allows you to do that and to take these other deductions we were talking about, the non-reimbursed employee expenses and charitable contributions, medical contributions. You can't take any of those if you're not itemizing.
So, which leads me to actually even another question. So, actually, with the caller, if you would mind, we'll go ahead and hang up.
How about the
if
land?
you can...
If you buy the land, that's also worth it?
Well, yes, I do believe it's worth it, but you're not going to get the same appreciation rates with land, depending on where it's at, that you're going to get with single-family residences or homes. If you're going to buy land, then the suggestion would be to look at where the direction of growth for the suburban areas are going to be. You want to, generally, what we used to look at is where were the Daris at, and when the Daris sold, that land became very, very valuable, and I'll give you an example in just a moment. And then we look at where did those Daris move to, because they're buying large parcels of land. That's the direction of growth, and it's those large parcels of land that they bought that'll become worth more money. Now, I recently represented a client who owned a dairy, and he sold the dairy for housing. He bought land at about $800 an acre way back when he bought it. But we just finished the sale at $400,000 an acre. So land can be a tremendous benefit to you if you buy it right. And just remember, like any other business, it's always about location, location, location.
Right.
You've got to be smart about how you pick it.
Yeah. From what a lot of folks say, that if you really want to buy land, the best place that you can buy land is across the street from a McDonald's, because
Absolutely.
they will be around for life.
One more question. I'm so sorry, but IRS will be not after us.
Oh, no, of course not.
The IRS, they will not hurt us. That's what you're doing, borrowing money from 401k, and then you're buying land or houses. It doesn't hurt.
You can borrow money from your 401k or any other entity that you choose. The IRS doesn't even care as long as you're meeting the terms of paying the money back. Now, there are some 401k programs where you don't even have to make any payments paying it back, but before you leave your employer, it must be totally paid back or you have a problem. The IRS does not care. Borrowed money is not anything that's reportable, and it's not taxable to you.
Okay. If in the case you're losing the job, what will happen? We have to pay 10% more?
Yes, it depends on why you took the money out. But remember that the reason that you're not paying any taxes or anything on the borrowed money is that the actual liquid cash has been replaced by a note, so the value in the 401k remains the same. Now, if you borrow money for investment purposes and you leave your employer is going to send you a 1099-R that's going to show an early withdrawal of that amount of money that's got the balance left, and you will pay not only the tax but a 10% penalty.
Okay.
Another question, if I get the age of 59 and still I have this money, what will happen after the age of 59?
Well, 59 and a half, keeping in mind that on all retirement programs that you must be participating for a minimum of 5 years or age 59 and a half, whichever one's later, and that if you're 59 and a half when you take the money out and you don't pay it back, you will not be subject to the 10% penalty, but you will be subject to the tax.
Because it's just
Thank
income.
you so much. Really appreciate it. God bless you for everything.
Thank you.
Appreciate it.
Thank you.
Thank you for dialing in.
Papa, really appreciate it. Papa.
Sure, you're welcome. So the question here is that, you said, buying real estate today is obviously prices are lower. Now, unfortunately, some folks got into that business. Well, I shouldn't call it business, but either they bought a home or maybe they bought an investment property. But now they're in a position where the note itself is worth a lot more than the value.
Yeah.
And not only that, but the bank actually reset some sort of an exotic loan that they had. And so they're in a position where they may be paying 7, 8, 9, 10% on one or two notes on a property that, quite frankly, is maybe worth half of what they paid for. There's some choices that they can make.
Well, there's a lot of scenarios, and I think we should probably briefly touch on all of them.
Okay.
Let's talk about the people that, when real estate was booming, they got in and they were highly leveraged and probably didn't qualify for the loan when they got it, but because of what was going on, if you were breathing, you could get a loan.
Right. Yeah. Stated income.
And so what happens is they bought a home that was beyond their means, and then all of a sudden we got the recession, and that home they bought is only worth about half of what the loan is on the home.
Right.
Now, as a counselor to people, one of the first things I would say to them is you know what? Based on my knowledge of economics, you are never going to recoup the lost equity in your home. It makes more sense for you either to do a short sale if the bank will allow it, or do a deed in lieu, which means that you're just signing over a deed back to the bank because your property is the only collateral against that loan. You can do that, even though the banks don't like it, or just go through a foreclosure, in which case you're probably going to live in the house for a year, year and a half, maybe even 2 years without making any payments. You can be socking money aside while that's happening.
While you're waiting. You're buying time, basically.
Yeah, you're buying time.
Okay.
But it doesn't make sense to say, hey, I'm going to stay in this house, I'm going to recoup the money. That's just not going to happen. So from an economic standpoint, you need to bite the bullet. Now, either you buy another home before you go through this process, or you decide, hey, you know what, I'd rather be a renter anyway. But the thing is that if you have done a short sale, which is nothing more than the bank saying, I'm going to allow you to sell your home for less than you owe on it, and we're going to wipe out that debt.
Which sounds great.
It does sound great. And if you go through a foreclosure, you're going to get what you're going to get is the same thing. And the effect is going to be the same thing. You're going to get what's known as a 1099-C. Now, that is a debt forgiveness 1099, but there are a couple of issues here where it affects you or doesn't affect you. If you did a short sale and or you did a foreclosure or a deed in lieu, and it was your occupied personal residence, then that debt forgiveness is not taxable to you. If it was investment property, maybe you had a rental home or it was land or something like that, and you did that, then the debt forgiveness is taxable to you. There is an exception to that, and that's under financial hardship or insolvency. And insolvency is nothing more than when you owe more than the assets that you have. And if that's the case, you're insolvent. If you're insolvent and in dire financial stress, then there is going to be no debt forgiveness tax on you. But you need to be dealing with a professional who knows how to analyze those situations.
So there is a solution.
Yeah.
Because oftentimes people feel, quite frankly, ashamed, embarrassed, that they got in sort of a predicament, and they have an attachment to this home. That is really their home. They've been there maybe 3, 4, 5 years. It could be a little bit longer. But the point is that you've worked on this house every weekend. Your children grew there for the past, 5 years or so. And now you're in a position where not only do you have to admit that you cannot afford it, but you're going to walk away and quite frankly, you may not be able to qualify for another home. So, but the good thing here is that there are opportunities to actually give the house back, so to speak, without financial penalties beyond what you're currently on.
The other thing is if we're talking about, we need to be thinking about credit. We need to be thinking about emotions and get emotions out of this decision. You've got to be thinking with your head and not your heart.
Right.
So at some point, if you were to walk into my office, one of the options we would be talking about would be bankruptcy, especially if you had investment properties. Because in investment properties, if you're in financial hardship, it's not going to just be the property. It's going to be credit cards. It's going to be car loans. It's going to be personal loans. It's going to be all kinds of things. And so keeping in mind that at some point you need to recognize, hey, I can't get out from under this. I need a breather. That's why that law exists. You declare a bankruptcy. It's all forgiven. Never, ever, ever is any penny of money discharged in a bankruptcy taxable. And that's what you got to remember. So it depends on what you're trying to accomplish and what's going on. There are people that maybe lost a lot of equity in their home, but it was the last home. It was going to be where they were going to retire. They didn't care. It wasn't. They didn't buy that home as an investment. They bought it as their last place, right? Now the kids might not agree with this, but basically they don't care as long as they can make the payments, or maybe there are then they don't care that the fact that they lost that. That does happen in a few cases, but very few. I think what you really need to do is to stand up straight, go in and seek some professional advice, find out what options you have available to you. You not only want to save your financial ability to recover, but you also want to save on the taxes. If you wind up having discharged $300,000, that's going to put you into that 35% tax bracket on and so you're going to owe $100,000. How are you ever going to pay the government that? And they're going to charge you 22% interest a year plus penalties.
Wow!
So it makes more sense to have it maybe discharged. So you need to talk to a professional to figure out how to analyze what's best in your case. The decision's always going to be yours.
Absolutely. Now, when you say professional, we're not talking about going straight to the bank that actually has your loan and saying, hey, look, here's the story, here's everything, all my records, please help. That's not what you're saying.
No.
Okay.
I'm talking about going to an accountant, going to a financial expert, going to maybe even an attorney. Most attorneys, if you're going to do that, you want to go to a tax attorney.
I understand this.
When you're dealing in the law and you're dealing with with attorneys, they specialize in specific areas of law, and they're really not qualified to talk to you about finance. They're not qualified to talk to you about real estate. You might be able to go to a bankruptcy attorney. He's qualified to talk to you about bankruptcy, but he knows nothing about tax.
Right.
So you always need to talk to some tax expert, even if you're going to go bankrupt, because let's assume you owe back taxes.
Right.
If you owe back taxes, your bankruptcy attorney may not realize that any taxes that have been filed that you owe 3 years or older from the date of the filing of your bankruptcy can be discharged. The taxes, the interest, the penalties, everything, and interest and penalties right up to the day of the filing of the bankruptcy can be discharged, and many times that's more than the actual tax you owe.
So the statute of limitation is 3 years? Is that what you're saying?
Well, it's not really a statute of limitations. What it is that you must be currently filed.
Okay.
And if you're going to file a bankruptcy, any taxes that you owe for taxes that were timely filed 3 years or older prior can be discharged.
Okay. Oh, that's great.
Yeah.
Okay. Now, what happens?
But you wouldn't want to do that without getting rid of the credit card bills and everything else.
Of course. And typically that's what happens is that folks, not only do they have, for example, a home that they're really upside down on, but they also have maybe lost a job, maybe had to put the child through school, or there's some medical expenses and whatnot, and they just didn't have the proper planning, so everything went into a credit card, from one card to the next to the next. And so what you're saying is that, there should be a methodical plan to be able to not only consider the home as an entity that you want to get rid of, but also all these other financial burdens, so that you walk away from this.
You don't walk away. You walk away whole, but you don't walk away unscathed, because you're gonna sacrifice some assets.
Right.
But what the government does, that's the beauty of this program, and that's why it was instituted to start with, is to give everyone a second chance.
Right.
If these things happen, it's happened to everyone. I can tell you, Walt Disney, who's revered, went bankrupt 10 times. Now, many of those times were through different corporations and different entities, but even his own personal self had gone bankrupt, and it was this silly mouse with 3 fingers that made him a multimillionaire and built Disneyland. So you never know what's going to happen. Everybody needs and deserves a second chance. That's why that's there, and you should never be embarrassed, because you know what happens? You go. They have they segment the bankruptcy hearings per hour. Every hour they have about 60 people that are in there going bankrupt. There is a trustee who's really an accountant.
So wait a minute, 60 people in 1 hour. That's
in 1 hour.
Person every minute.
You're going to spend 1 or 2 minutes with the trustee.
Okay.
And generally you're out of there. And every hour that's happening, and here's the thing, you shouldn't be embarrassed. If you see somebody in there you know, it's because they're doing the same thing you're doing, number one. But you're probably not going to see anyone in there you know. And if there is somebody in there you know, they're going to probably ignore you and hope you don't see them. So don't even worry about it. Right. And when you walk out of there, you're done. And, here's the deal. You file for bankruptcy, and within about a month, you're going to have what they call a 341A hearing. You go through the hearing. That lasts about 2 minutes. You'll be in there for an hour, but it lasts about 2 minutes. You're a part of it. You'll get out of there, and 60 days later, you're going to get a notice of discharge. You're done. You don't owe that money. And if you hit the lottery, the next day, it's all yours. You don't have to pay back that money.
Because that's beginning.
It's gone. You don't owe it anymore.
Looks like we have another caller. Would you mind if we take
No,
this?
not at all.
Okay. بله زرین تیوی بفرمایید.
سلام علیکم تیمور جان.
وعلیکم السلام.
مزد میخوایم بازم یک سوال داشتم.
بله بفرمایید.
Mr. Robert, he mentioned that bankruptcy, if somebody, if you have a good job, you have a house, and you have some land. In the case your credit card business is not, like nowadays the business is very bad. Can you file for bankruptcy or no?
Yes, you can. Your personal residence, you can. There are debts that the government allows you to reaffirm, and your personal home is one of those things. Now, the government doesn't allow you to pick and choose what you're going to discharge and what you're not, but there are exceptions. And your personal home is one. They won't make you if it's homesteaded and you don't have a lot of equity in it, they will not make you sell your home to pay off any debts. Investments, they might take over your investments. They're not going to let you keep that kind of stuff, but they'll let you keep your home, they'll let you keep your car, they'll let you keep your furniture and your appliances. They'll let you keep.
And then you have like two land also, if you want to build new house, you have good land, they will come after your land or no?
Yes. Yeah. Yes. Yeah. This is not something that they're going to let you get rid of all your debts and keep all your equity. This is a new chance and a new start.
Right. Where can we sign up for that plan? Can we make that plan happen?
This new chance and a new start?
Now, wait a minute. You mentioned that there's certain assets that are exempt.
Yes.
What about qualified retirement plans? In other words, 401ks, IRAs, and those things. Are those exempt from bankruptcies?
Well, now, first of all, I need to give a disclaimer. I am not an attorney.
Right.
And so I'm not giving legal advice. And very honestly, it depends on the kind of retirement program you have. And I'll give you the case in point, and that would be O.J. Simpson. O.J. Simpson, as part of the National Football League, had a retirement system worth millions and millions of dollars.
Right.
And even though he has lost the civil suit and he had this huge judgment against him,
right.
And now that he's in jail, they can't touch his retirement because of the way that it was set up.
Okay.
Other retirements can be touched.
I see. Okay.
So you've got to be very, very careful and know what you're doing.
So there isn't a way where you could say if it's a 401k plan, for example, it is most likely exempt, but on IRAs and probably not.
Probably not.
Okay,
probably not. And but I would encourage you not to listen to me saying probably not. I would encourage you to go to a bankruptcy attorney who actually knows the law and is qualified to advise you that way.
All right. So it's important because, for example, let's say you've been saving. Okay, well, we'll go ahead and hang up on you on the caller. Thank you so much for dialing back. If, for example, you've been saving, let's say, for 25 years, right? And all of a sudden you run into a predicament where you lose your job, you lose, you have a home that you bought that was much bigger. Quite frankly, you can't afford to pay for. Yeah. So you have two things. Perhaps you have credit card debts and whatnot. So you have this financial burden on this side, and then you've also been pretty diligent throughout by saving. That can be somewhat in jeopardy.
Yes.
Okay, and that's important so it's a complicated situation. However, like you said, there are second chances. And
in Florida, they can't touch your home, no matter how much equity you have in it.
No kidding.
The state of Florida in the bankruptcy laws.
Your primary residence, not your investment.
Primary residence.
Right, okay.
And so, it depends on what we're talking about. But you've got to remember the spirit of the bankruptcy law is to give you a second chance, not to let you come out of this ahead of where you were at. Yeah.
Right. Okay. And so we talked about on the corporate side some ways that you can actually save on taxes. And if you recall the video that I played earlier, you'll notice how much impact taxes can have on your savings. In other words, that $1 that doubled by year one, and then it kept doubling and doubling. In other words, it compounded. In 20 years, $1 turned into $1 million. However, if that dollar was taxed every year as it was growing, that dollar turned into only $27,400 in 20 years. So there's a huge difference here in terms of paying. Now, we all pay our taxes. We're all citizens of whichever country that we're in. Now, this show obviously is broadcast worldwide. Well, it's our civic duty. It's our civic responsibility. We want to make sure that the country's better. However, like Robert says, there's no point in paying an additional dollar because they don't give you a reward for it. You don't get a ribbon. You don't get a certificate of appreciation. And essentially, it's a waste. So we talked about some strategies on the professional side, on the corporate side, and how you can structure your business. There's a handful of different ways, whether it be through retirement, whether it be through different entities, and also life insurance, that you could benefit on multiple levels. We also talked about on the personal side, where for example, home deduction is a great thing. However, some people got in a little bit over their heads, entirely out of their hands, and like Robert says, there are some ways where you can actually come out of this, and so that you can start up again and grow. So we covered quite a bit here.
Yeah, and we're only touching the tip of the iceberg.
Absolutely.
Every one of the things we've talked about, you could get into tremendous detail in.
Right.
But I think sometimes that detail just confuses, muddies up the water a little bit.
Right.
And it's better to let people get a broad idea of what's available and what they can do. I've got to tell you what, I still believe that this is the land of opportunity.
Absolutely.
And for those people that can take advantage of the opportunities that are there today, even if they have to sacrifice to do that, in the long run, they're going to be much better off. But you need to be thinking wisely.
Right. So it's not necessarily about how much you make. It's important to make a lot of money, but what's important is how much you get to keep every year after you pay your taxes. So we got some pretty good advice, a lot to think about. I'll tell you what, one thing that I can go back to is that, like Robert says, that tax planning is quite complicated. If you're working with someone, make sure you go back to them and bring up some of the topics that we talked about today. And otherwise, if you're looking for a professional, go out there and find someone. Now, Robert, unfortunately, you retired.
Well, I'm semi-retired.
Semi-retired.
Actually, so let's talk about my retirement.
Let's.
Okay, so I'm still doing taxes for about 100 different companies.
Right.
I'm just not doing any accounting work anymore.
Right.
I'm still consulting for a number of people, and for those companies, the owners, I'm doing their personal taxes.
Right.
Because you can't do one without the other.
Sure. Right.
I'm doing a lot of consulting. I'm the chief financial officer for this entertainment company that I was telling you about. That's a new thing, so I'm doing that. And I've got a radio show Monday through Friday. So when I talk about semi-retired, what I mean is I'm not working 17 hours a day, 7 days a week anymore.
Right.
It's an interesting, odd feeling. I get into the office at 8. I'm out of there by 12:30, 1 o'clock. Go home, have some lunch, relax a little bit, and then off to the studio to do my show.
Right.
And so when I say semi-retired, it's probably a full-time job for most people.
It sure is. And the radio, again, some folks may actually want to tune in. It's Monday through Friday at...
It's Monday through Friday. It's Robert Cardoza Live. It's at 10:50 a.m. Station, but you can also get it on the internet at kcaaradio.com. And from there, you can see it on HDTV if you want to see an old guy like me with the earphones on in front of microphones. You can also listen to it live. You can go to my podcast right from the station site, or you can go to my website at robertcardozalive.com. Everything that I talk about on my show, all the opinions that I have, they're all there on not only on my website, but you'll be able to hear the podcasts of my show and replay them anytime that you choose as well. So it's an exciting show for me. Something I've been doing for a couple of years. I really, really enjoy it.
Well, we appreciate you taking the time out of your busy schedule to come out. In fact, today it was raining quite a bit, and it took you about 2 hours to come to the studio. So we appreciate you coming here. We appreciate your advice. And we also appreciate that you've extended the invite for folks to actually dial in to your show so that they can have access to it. Will they be able to take calls on the show as well?
Oh, absolutely. They can call me toll-free on my nickel at 888-909-1050. And that's between 5 and 6 o'clock Pacific time. Okay. And so, again, that number is 888-909-1050. The engineer will take your call and put you right through to me on the show. I have never embarrassed anybody or picked on anybody on the show. Don't intend to do that. So I welcome your phone calls and your questions. And I'm, at the beginning of my show, I actually answer questions from all over the
Yeah, you mentioned that you answered one email that was specific as sort of a showcase for that particular show. Well, very good. We'll go ahead into a commercial, and before we go into the commercial, I wanted to play a short video for you. We'll go into the commercial, we'll come back, and we'll close the show. So stay with us. Okay.
Return that you've done the reconciliation between your W-2 and your 1099. Get all of that income reported. The IRS is getting much better these days at reconciling your 1099s and W-2s to what you put in the mailbox. Number 2, if you have rental property that's out there, make sure that you look at all of your tax deductions. Look at your deductions associated with the cost of charitable work. And for 2010, there's always your individual retirement account deductions. Those deductions in this year is $5,000. If you're under age 50 or if you're over age 50, it's $6,000. Look at the tax credits that you can claim for this year. Maybe you're not sure all the credits that are out there. If you're not, pick up publication 17 and look at tax credits on your individual return. There are credits for education, credits for earned income, credits for energy, credits for caring for your child.
Cut. Yara, about enough of this movie-style trailer bakwas. Come on, Yara, Hollywood and Bollywood out. Every single dars that we do, every single seminar needs one of these crazy trailers. Folks, 2011, the biggest course to hit you is coming. Fiqh of Buyur. And no, unfortunately, it's not super exciting, bang, 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 as normal. But what it is, it's probably the most important course that you're going to take. Fiqh of Buyur, the fiqh of transactions. Transactions are those things that it's a very long word, but we get involved in every single day. When we go and buy a pack of crisps, a drink, a car, you're taking out a loan, getting involved in a credit card, a debit card. When you go into finance, student loans, mortgages, pension plans, 401ks, all of these things are transactions, and I can guarantee you that the mass majority of people have no idea about the Islamic permissibility of these things. I get asked these questions all the time, and these are difficult questions. We need to deal with them. This is the course that's going to deal with it. It's not the most exciting, I agree, but the most important, possibly. The Fiqh of Buyur, Fiqh of Transactions with me, Abu Isa, inshallah, coming to a city soon. See you there. Jazakumullah khair. Assalamu alaikum wa rahmatullah.
Since 2004, volunteers with the Rebuild Afghanistan Summit have organized an annual one-day event to mobilize their local community in getting involved with the organizations and businesses that are working to improve lives in Afghanistan. We achieve our objectives by bringing together NGOs and nonprofits, businesses, political leaders, and private and institutional donors to network and share ideas. And all our events are free and open to the public. Having started in San Francisco, satellite events sprang up in Los Angeles, Washington, D.C., New York, Germany, Jordan, and now you can help us organize the event in even more locations, creating a global network that improves lives in Afghanistan. Our success depends on our volunteers, and you can get involved today by joining one of our existing teams or by hosting a summit for your local community. Give us a call and we can show you how you can make a difference in your community and Afghanistan's future.
خب بینندگان عزیز، تشکر بسیار زیاد از وقتتون. خدا کنه که برنامه خوشتون آمده باشه. برنامه امروز درباره تکس پلنینگ بود، تکس استراتژیز. یکی از دوستا رو آوردیم که تقریبا 35 سال تجربه تکس پلنینگ داره. اگر چیزی علاقه دارین که می‌خواستین به تماس شوین، معلومات خود پیشتر براتون داد و همچنان به وبسایت zarintv.net میمونیم. یک اعلان کمیال نشر کردیم ریبیلد افغانستان سمیت هفته آینده است، سنده آینده اپریل 1 از 10 صبح تا 5 دیگر و بعد از او ام سی یعنی از خود افغانستان سمیت باز میاریم به برنامه که اگر علاقه دارین میخواستین که شما اشتراک کنین نتونستین متاسفانه خود برسانین به این ساله، شما میتونین که دوباره معلومات بگیرین از طریق زرین تیوی و پالیز لندن در تاریخ 8 اپریل نوروز تجدید میکنن، چیزی که معلومات اگر میخواستین از فیسبوک بگیرین و همچنان اسلامیک فایننسینگ یک پروگرام دارن در کالستیت فولتون، او را از طریق وبسایت ما شما میتونین معلومات بگیرین. تا هفته آینده بخیر گپ میزنیم. روز خوش میخوایم براتون. خداحافظ.